I'm the co-founding partner, co-managing partner of Loyal VC. So over the past 4 years, we've been running open-ended venture fund. And just for background, I've spent 20 years as an entrepreneur, 15 years of that as an angel investor, 7 years of that first running, then designing accelerator programs. So over that period, I've probably directly advised on the order of 500 different companies. So I'm speaking not just from my own experience, but from having seen hundreds of different startups out there, having seen hundreds of financings being done, having seen how valuations happen. But the valuations conversation became very, very real for us when we launched our fund, because we have now invested in over 225 companies, and our fund is an open-ended fund. That means every quarter we set a price for the fund. We allow people to buy in or sell out every quarter. They can redeem their units or they can buy new units. And because of that, we must do a full valuation of 225 companies every quarter. That's a very significant activity. And as we've been doing it, we've got a very good LP advisor committee who's been advising us, with people from the industry advising us as we've moved forward. So I'll share some of that learning and experience, but this is a very real topic for us. Now, open-ended funds, there are other open-ended funds out there. There isn't really an industry established methods so far, but we're starting to get there. And Sequoia moved all of their funds to open-ended in October of 2020. They haven't advertised a lot about how they do those valuations, but I mean, if you're doing an open-ended fund, you pretty well come to, you need a market valuation. You'll end up with an approach probably similar to this. It's worth mentioning that the concept of open-ended funds is not new. There's been about 200, people estimate there's been about 200 open-ended funds over the past 20 years. Now that's only 1% or so of all venture funds. So, so this sort of doing a valuation on what something is really worth is something which has been limited to a very small number of funds. Only 1% of the funds need to do it. But let's just jump in, and I'll start by talking about how are VC investments valued in the industry. There is a standard process, and if you're working for a VC fund, the odds are 99% that this is what you will do. And this is what the VC funds do, this is what the accountants do, this is what the valuators who support them. And there's two basic principles which people generally use, which say, when you've invested in a startup, there is no market in the startup except when there's a follow-on investment into that company. And whenever there's a follow-on investment into a company, at that point, the value is known exactly, because people paid a specific price per share when they made a follow-on investment. So you should just use that share price. And then other than that, okay, so every time there's a transaction, use that share price. And if there hasn't been a transaction, well, you always keep the asset at cost. I mean, you, the VC, invested in the asset, so you keep it at your original cost until there's a new investment. You keep it at that cost and that share price, unless the investment is impaired. Now, some people will use a DCF or market comparables approach, relatively rare in VC, but I'll talk about those also at the end. But it seems very simple. It's what someone paid for it. That's what it's worth. The problem is, when you talk to people in the industry, they say that the standard process gives massive overvaluation. And I want to share a quote here. This is an exact quote from an email which was written to us by someone who's spent over 30 years as a private equity fund managing partner. And he was writing an explanation explaining why he would never invest in an open-ended fund. And he said, look, valuations are hugely skewed upwards and rarely get valued down other than for permanent impairments. And he talks a little bit about why this is. He says, look, this sort of cost basis, unless impaired or unless there's a follow-on markup, gives stability. And he says institutions like this stability. They like reducing the downward volatility compared to the public markets. And if you're holding the asset to maturity anyway, the valuation is background noise. It's directionally educational about the quality of the portfolio, but it's irrelevant. And this is why most VC funds are closed-ended funds. That you don't need to worry about pricing. You put money into the fund, you're going to get it back in 10 years. Everyone buys in at the same price, and everyone gets back what's left. But valuation is unnecessary. It is this background noise, and it's actually good for the people who've invested. There's a nice, stable price evolution. And if it's wrong, Who cares? Because it doesn't really matter. If you want to look at where is this inflation coming from, the number one source of inflation is, well, in my belief, is deal terms. And this is very common. I mean, look, you have someone who comes in and you may have initially invested in common shares or Series A shares, but for simplicity, let's say you start off with common shares. I mean, we have a company which was just acquired where they issued us common shares. And the common shares, this current company is out there with Series E preferred shares currently being issued. So Series E preferred shares, for instance, here are some sample terms. So if it's good for the investor, they convert to common. But they have a series of other protections. They've got a 2x liquidation preference. They've got a down round protection. In this case, there was actually some warrant coverage. So everyone who bought a Series E share got both shares plus some added warrants. And the challenge here is you can take the same price per share, which is what everyone does. And that is exactly wrong. I mean, everybody knows. I mean, it's common sense to say, would you rather have liquidation preferences, down round protection, or even added warrant coverage, added warrants along your investment? Of course, what's on the left is more valuable than what's on the right. But the challenge is, how much more valuable is it? And the industry standard is to say, well, that's an impossible question. We don't know how much more valuable those terms are. So if you don't know how much and you want to be exact, then you take the exact price, because if you're going to take a lower price per share, you're going to have to estimate the probabilities of different outcomes. And that is it's not just that it's a hard process, it's an inexact process. It's very hard to defend, but you are more right with it. And there's a great study by Gornell and Strebolev out of Stanford talking about squaring venture capital valuations with reality. And they looked at 135 different US unicorns who listed, and they said on average, the post-money valuation, so i.e. this share, was 48% above fair value, because at the point the company lists, then you see what really happens. And they said that with 10% of the companies they studied, it was more than 100% above fair value. So you see large amounts of valuation inflation in these deal terms. And but everyone likes it. If I'm an early shareholder, I get a big mark. If I'm an early investor as a VC fund, I get a big markup. If I give you all sorts of special deal terms, I can just continually get better and better markups. I use those markups to be able to raise a new fund. And however much money comes out at the end when the listing, the exit actually happens, well, that's what happens. If we want to start calculating probabilities here of what these deal terms are actually worth, you need to be able to sit there and say, okay, what are the probabilities of different outcomes? And just as background for you, these are the industry-wide outcomes for venture capital deals. 65% of deals fail. In fact, about 50% of deals will fail absolutely, and about 15% will give you less than your money back. You cover your losses from about 31% of the deals. So in fact, you can see the math here, 65% give you some small fraction. And like I said, it's 50% and then 15. 31% of the deals will give you on average about 3 times your money back. And you make your money back from these first 96% of deals. And as a VC, all your profit comes from your home runs of 4% of the deals. So you make about 1 times your money back there. But interestingly, note, you make half your money back. You sort of get your money back again here, and you make the same money gain from the 4%. So you do get money back from these first investments. So if you sat there and say, what's the value of a liquidation preference, for instance, you can say, look, if the company does very well, in those cases, you're just going to convert to common anyway. The common is the same returns as the preferred, depending on, you can write other terms, but we'll make it simple here. And you can run the math and say you make about 1.72x, but the valuation of that liquidation preference is about 0.28x, because in these situations in purple, with the liquidation preference, the people with the liquidation preference make money and everybody else doesn't. So you can see that there's about 50% of the time the company will fail, 30% of the time that liquidation preference kicks in. Only the people with the preferred shares make money. And in about 20% of the time, everybody makes money. And you can see, given this rough scenario I did, that the common shares are worth about 86% of the underlying preferred shares. So these are the types of calculations you have to do. And you can see this is all based on estimations, probabilities of future outcomes, and it's very inexact. But it's certainly getting you closer to what that real value is. Now, let's talk for a second about the incentives of professional valuators. So here's Thomas Lee. He's one of the guys who's advised us. He's on KPMG's global valuation team. But as you start talking to valuators, you start to see that being exactly wrong is actually rewarded. It's the easy thing to do, and approximately right is actually very risky for a valuator. And the thing is, from a valuator's point of view, why do people want a valuation? Well, you want this professional valuation. Fundamentally, it may have to stand up in court, and the firm's professional reputation is going to be tied to that valuation. And as far as a valuator is concerned, it's a very simple thing. You, the person asking for the valuation, should be picking a process. They'll say, yes, is that a reasonable process? You follow that process. And then importantly, they have to prove later that that process was followed exactly. So when you talk about doing something which is an exact number, the exact price per share of the follow-on round, that is defensible because it's really easy. You can't be proven in court wrong. You say, I did what I should. I used the price of the follow-on round. And by the way, this is the industry standard in venture, so it's a very defensible thing. And the second I say, well, actually, those were Series E shares and we had common, so I had to mark it down. I used my judgment to make an approximation of how much it got marked down. Well, that becomes very hard to defend in a court. And this is where people run into sort of having troubles. And look, honestly, as far as a evaluator is considered, right accuracy is not their number one consideration. Their number one consideration is following a repeatable process and doing that well. And this works for the industry generally if you are a closed-ended fund, because as you remember, they were talking about valuation as background noise. It's not a basis of trades. Whereas when you run an open-ended fund, it is a basis of trades and you need to start to do better. Now, I've talked a little bit about how you could do better by just showing an example of how you could adjust for deal terms in a valuation. And in fact, that paper by Gornell and Strepelev also has some very good math on adjusting deal terms. But if you look here, the other thing which is really interesting, and the other reason I believe why you see massive overvaluation with this process is this. We'll turn for a second to this sort of principle of keeping your asset at cost unless it's impaired. On average, successful startups have follow-on fundings every 16 months or so. So you can get, and the median time to fail is actually quite long. Companies take about 36 months. Half of all startups who are going to fail in 36 months. If you want to get 90% of the failures of those who are going to fail, it actually takes you about 5 or 6 years. So if your median time to fail is 36 months and you can get markups every 16 months, you'll remember that about 2/3 of companies will fail, but those are taking a long time to happen. So that impairment is happening very slowly, and you can get 2 markup rounds from the successes in the time you get even 1 mark down. And the other thing is you can actually, as an investor, if you've got a company of yours which is in trouble, many VCs are famous for saying, okay, the company's in trouble, I'll give them a little more money to see if they can turn it around. And what that's doing is extending the time to fail. Now, ultimately, 10 years out, 12 years out, when you see what happens with your portfolio, the successes will make the money they make. And a lot of these, I mean, VCs refer to them as walking wounded. A lot of these walking wounded, I mean, the company is a dead man walking. It's going to fail ultimately in most cases. But they've extended the life of that and delayed the time to the markdown. So the markdowns happen towards the end of the fund life when, yeah, that's when sort of everything becomes obvious. But this is because of this, keep the asset at cost and less impaired, as opposed to marking it down. Now, what would you do if you actually wanted to look at this? Again, I mean, any sensible business person would look at this and say, let's start to evaluate what's going on in the business. So for instance, look, you look at the company's team. What happens if the CTO quits and takes the whole tech team with them? The asset isn't impaired. It's still got the same returns it had it before, but clearly this company is worth less. What happens if their sales are running 50% below sales forecasts? Maybe they lost a flagship client to a competitor. Their latest release is overdue by 3 months. Customer average time on the site is down 50%. Their cost to acquire customers tripled. I mean, you can look at every one of these things and say, these are significant negative impacts on the company, and you should mark it down. The challenge is, well, by how much? Because the second you start marking things down, you're entering the realm of approximations. So if you're going to do it, you're going to be approximately right. You know the company's worth less. But if the CTO quits with the whole tech team, yeah, the company's worth less, but how much less? You're going to have to make an estimate. If you don't make those estimates, you've got an exact price, but that price is wrong. So you can see here the challenge there, but these are fairly straightforward things to do. You can sit down and look at a company and say, okay, how much would I have paid for this company if they didn't have a tech team and they were looking to hire a new tech team? It's a fairly straightforward thing to say, I would have paid approximately this, but you can start to see the challenge here and why people don't normally do this. I'll move for a second to DCFs, because especially I know there's a number of you who are students on the call, and DCFs are something that you study very in detail, and this is considered to be the way to value things. I think DCFs make a lot of sense when you're dealing with mature companies with relatively known situations. So the company has 10 years of history, they've got an established market, they've got established customer base, and you're making forward forecasts. And even in private equity, I believe that DCFs are probably quite useful. The challenge is we're not dealing with private equity. We're dealing with startups, and startups are very unknown. And I'll just remind you of these sort of stats here again. 65% of companies fail, 31% will return 3x, and only 1 in 25, only 4% of your companies will return 10x. Well, the problem is VCs will only invest in a company if they believe it's a home run. There's no VC out there who says, I'm investing for base hits. They all go, I invest for home runs. Every one of the portfolio companies, I will refuse to make an investment unless I think it's a home run. So you're sitting here saying, okay, well, great. I have to do a DCF on a scenario. What's the scenario? Well, every VC will have the scenario which says this investment is a home run. Here is the financial model, which shows this company returning 10x. The thing is, every VC for every one of their deals has that DCF, which shows here's how this investment returns 10x. But we know industry-wide, this is only going to be true 4% of the time. So why on earth are you going to build your whole valuation on a scenario that happens only 4% of the time? And honestly, if you are going to get into the business of doing valuations of early stage companies, sure, you can do a DCF model, but you shouldn't be doing a DCF model. You should be doing scenario analysis. You should be doing scenario analyses which say 2/3 of the time these companies are going to fail. Here are some different scenarios of the outcomes. Here's a DCF for each of them. And by the way, if you're doing that, you no longer need to just artificially increase risk by just saying, oh, my discount rate on my DCF is 30% rather than 15%, because this is a more risky investment. The risk is all taken out by saying 2/3 of the time it'll fail. That's scenario number 1. Scenario number 2, 3, 4, each has a DCF associated with them. Each has a sort of a value of the company, and then you can build up a valuation that way. So that is the way, and it's really in this realm, scenario analyses are much more accurate if you're going to do them. Now, they can be very hard to do, but they're still more accurate. And it certainly gives you a more interesting way to think about it. I mean, the example I always love is Google. So Google, I believe when they got their venture capital investment, they had two VCs, each put $10 million into Google for 10% of the company each. At the point when they had a good search engine, which had a better way of doing things, but they had virtually no customer traction, let alone revenue. And you're sitting there saying, how on earth in any rational financial analysis can you say, this is a $100 million company, and I'm going to put 10 million in to buy my fraction of the $100 million company? That investment doesn't make any sense. And yet, you know that the VCs who invest in Google are delighted with buying 10% of Google for $10 million. So there's a good example of how it makes sense only when you're dealing with a scenario analysis, only when you're saying, there was a small probability that this search engine would become a massively used thing with all the traffic on the internet, et cetera. But that is the point when you can say Google had, pick a number, I don't know, a 10% chance of being the search engine, dominant search engine in the world. Whatever the probabilities were that those VCs were looking at, that would be the way to value it. And if you say it had a 10% chance of being the dominant search engine in the world, and that would make it a $100 billion company or whatever it is, gosh, 10% chance of it being a $100 billion company. In fact, even a 1% chance of it being a $100 billion company says that all of a sudden that company should be valued at $1 billion. And then, okay, if it should be valued at $1 billion, I'm getting a good deal when the company is valued at only 100 million and I'm buying 10% for 10 million. So that is the sort of the scenarios, the way you think about it, that's how you build up a valuation. I'll talk for a second about how we do our valuations. So we've spent a lot of time thinking about this to say, how would you value if you wanted to actually get the price right, which we need to do as an open-ended fund because people can buy in or redeem. And we've had people both buy in and redeem. It changes the quality of the investment because it's no longer your money's locked away for 10, 12 years, you get back what you get back. You can actually say, this is what the price is worth. Is it really worth this price? Well, guess what? I can redeem. So I guess it really is worth this price because I can get my money back out if I want to. But the first thing we do, and it is exactly the same as everyone else, we agree. There is a market here. When people invest in the market, that is a transaction. The market always rules. So past transactions are the strongest indicator of value. The only thing is you need to adjust them for deal terms. So we go in there and we do the adjustment for deal terms. I can get into this in the Q&A a little bit more. I'm mentioning this point here, weighting. It's been a really interesting internal discussion we've had, and especially with our LP advisory committee as well, is what happens when you have a small, unsophisticated investor investing into a company. Is that a market setting price or not? What happens if you think the company is worth only $20 million and yet someone else invests in the company and the sort of a friend of the founder puts in a couple of $100,000, they get a 50 million value. They give the company a 50 million valuation because they love the founder, they really believe in the future, etc. Is that an indicator of value? And our decision has been to say, yes, it is a market price as long as it's a valid transaction. You could look for checks to say, does this look like a bona fide transaction? And if it is, we do take that as a transaction, but we weight it and we say, look, if there was a large, sophisticated investor or really high quality analysis, then that price point is a good reference for a long period of time. Whereas if it's just been a few small people putting money in, that price point is weighted to be a sort of more of a short term. We sort of weight that. And the result is you will see some oscillations in the price, which by the way is exactly what you will see in the public markets often is prices will oscillate back and forth. But we can talk about that if that's of interest. The second thing, as we've talked about, and this is unusual part of scenario analysis, is the next most accurate early stage valuation methodology. In practice, this comes in when you say, hey, here's a company and they're almost out of money, but there is a 30% chance this new investor who's given them a term sheet is going to close it. Therefore, there's a 30% chance they're worth this. There's a 70% chance they're worth zero. And then you can do a valuation from there. The next thing we do, and I've given you a clue to it also, is we look at unexpected material changes. And we say if it's a material change which was not expected at the time people invested, then that should result in valuation changes. And there will be unexpected material changes, which are good ones, unexpected ones, which are bad ones. Put them all in the mix, and then do take a position on what the new valuation is. And it's typically really easy to agree that the valuation should go down or should go up based on these material changes. The challenge then is to say, what is it? And then we're in the realm of approximations, approximately right rather than exactness, which we all know is wrong. It is a general principle of valuation that comparable companies should have comparable valuations. A lot of people like to say this company is in this industry, therefore it has these multiples. And by the way, talking multiples just for a second, the common multiple you want to use in venture capital investing is you want to use a valuation to revenue multiple. And it's typically, I mean, you can do it to current revenue, you can do it to forecasts get awkward in venture capital, so I prefer to sort of people will often, you'll use your monthly recurring revenue, for instance, annualize that, but that is the one thing. It's very hard to do anything related to profits because many of these companies are operating at a loss. So that's probably the easy one. Profits all over the place, revenues more straightforward. I mean, many companies will be pre-revenue, so that metric doesn't make any sense. But most people will do comparables that way. They'll also look at industry comparables. We don't believe in industry comparables really making a lot of sense, because what happens is if you're a large mature company and you have 30% of the market, 30% market share already, whether your market is growing or shrinking by 10% really matters, because you can't increase by 30% a year when your market's growing by 10% a year, because pretty soon you'll have 100% of the market. So that doesn't make any sense. However, and we have companies in our portfolio, multiple companies whose sales are growing by 500% a year or more. So if you're growing by 500% a year, it's also because you have 0.01% of the global market. And your growth rate is so fast, you're basically, it's all about buying market share from everyone else. And whether or not, if you're going at 500% a year, if the market is going up 10% or down 10%, it sort of doesn't matter because you're all buying your market share from everyone else who's in there, or blue ocean creating a new market which wasn't there, but effectively will be replacing someone else. But when you're on those growth rates, you know, it sort of doesn't matter what other people in the market are doing, because you as a startup are growing so quickly within that market, and things become very unique to you. However, having said that, you can often find startups and we have 225 of them, so you can often say this company looks a lot like this other company, and this is what they're valued at, so it should be in roughly the same range. Now, Loyal operates in a very high trust environment where we invest only in people who are alumni of INSEAD, or people who are have done the Founder Institute Accelerator program, which, by the way, is open to all. But the result is, because we're in a high trust environment where we build up relationships over time, we actually listen to our founders. And the founders of the companies themselves have a very good idea of what market participants will pay for their company, because they are the ones who are out talking to investors on a regular basis. They know what's going on in their market. So we will actually listen to the founders to get another data point. These factors rank higher, but this is not something we'll ignore. Most people just ignore it and say a founder will say whatever they want to say. But if you really get to know them, they have information, and you need to get to a point where they speak honestly with you and share that without trying to peacock or make sort of big promises. And over time, you can build that relationship. And the last point, just a minor principle, but we are always focused on getting the right price. And if accounting rules say you need to do things differently, so for instance, we have a company which is this acquisition, which is a contingent payout. In accounting, they may say contingent payout of less if the contingency is unlikely, then you count it as zero. Whereas we say, well, look, if there's a 5% chance of a payout and it's a $1 million payout, well, a 5% chance of $1 million payout is worth exactly $50,000. It's not worth zero. It's not worth $1 million. It's worth 50,000. So put that 50,000 in. So we will sometimes not match accounting valuations. And just as the last slide here, I'll show you a little bit of, this is the actual data from our last valuation. So you can see a little bit about why and how were things valued the way they were. So everything in dark green or dark red was valued based on a recent round that was led by somebody else. And you can see the behavior I was talking about. The successful companies have a lot of further financings going on, and you see them being marked up. So the dark green is when that was led by someone else. The next shade down is when Loyal led a round. And then the last darkest shade here is a pending round, which hasn't closed yet. So there's a probability assigned to each of those. But you can see there's a whole bunch of markups there. Now we get to the light green and the light red, which is where we mark things up or down on performance. You can see in our most successful companies, we're marking up and down in performance about the same, but there's a whole bunch of these companies which are less successful companies where there's a large number of markdowns. The companies are not doing well. We are impairing the value. I mean, they're not impaired. They're not accounting wise impaired, but they're in trouble. So we're marking things down an awful lot. And then, of course, you've got sort of a pending down round or a recent round, which is negative. And often, by the way, the pending down rounds, a number of those in our most successful companies are actually Loyal. And it sounds really funny. We're sort of marking down a company which was valued higher. But we believe you make money by buying low and selling high. So we will make an offer to a company. Maybe the company hoped to raise money to higher valuation, hasn't done so yet. The other financing fell through. And we'll step in and say, yeah, we'd love to finance you, but this is what we think you are worth. The other people thought you were worth more. We think you're worth a bit less, but if you're happy to take that money, take it to valuation willing to offer, and you can come through. So a bunch of these are sort of Loyal, but this gives you an idea here of what the changes in a portfolio look like. So let's just sort of wrap things up. We've talked a little bit about how VCs value investments, how this leads to massive overvaluation, often because they use the price for the next round, which is sort of the deal terms aren't taken into account, which is hard to do because you can be exactly wrong that way. And people prefer exactitude. The valuators are motivated to get it exact rather than to get it right, because this is how they're measured. Being exact is easy to defend. We also talked a little bit, we talked a little bit about how there is an innate bias to mark things up quickly because follow-on rounds gives you markups. Impairment happens slowly, so that all of these things together are what leads to this overvaluation. What is the solution to this? You can mark based on performance, as we've talked about. It's easy to know the performance. It's easy to know directionally what you should do. You are going to have to make estimates. We talked a bit about DCFs and the challenge with them, and I've shared our approach. And let's stop there and throw it open for discussion.
So I think one question, go ahead.
No, go ahead, Sipanji.
Yeah, so one question that was asked in the chat box, and thank you, Abhishek, for that question, was, can you talk a bit about the most common terms and conditions used in the term sheet?
Sure. So we believe very strongly in the most common terms you see in a term sheet is, number one, you will see preferred shares. Almost every VC wants preferred shares. A lot of the terms relate to what happens if things don't go as planned. So preferred shares are all about making sure if the company does poorly, the investors get all the money, the entrepreneurs get nothing. And if the company does really, really well, only then does the entrepreneur get money. So that's where you get liquidation preferences, a 1x, a 2x liquidation preference, etc. You can get down round protections, but it's all about saying, if it goes well, then yeah, we share money. And if it doesn't go well, then we get it all. Loyal really likes common shares. We prefer to see full alignment between founders and entrepreneurs. So our advice to entrepreneurs always is to really try to do common share rounds, but that's very hard. The most common thing is to see these. The other protections you see, it's all about VCs and entrepreneurs are dealing in a very low trust environment, especially from the VC side. So they will see, the other thing you'll commonly see is board provisions. You'll see things that certain types of decisions by the company need to be approved by the preferred shareholders. So it's all those sort of control type things, which say, I need to prove you doing any of this list of things. If anything happens to the company, I get all the money, you get nothing if it's not working the way you're planned, etc. So that's really what the standard terms look like, is those sort of preferences and control.
So there are a couple more questions in the chat box that we have here. So Kirill is asking, could you please elaborate a bit more regarding how Loyal VC performs adjustments of deal terms?
Sure, absolutely. So that scenario analysis, which I shared on there, is an example of the sort of scenario analysis we do. When we don't have specific belief to believe a company is going to be, is any different from the industry average. And our general approach is to say, look, most companies have a probability of outcome. This is industry average outcomes. Most companies will have industry average outcomes unless we have a very strong reason to believe their probability distribution of outcomes looks differently. So we will do exactly that scenario I shared, but we'll sit down and we've worked it out for some of these different things. So for instance, and it's interesting, we've talked with different people in the industry about the value of preferred versus common shares, for instance. And there's a number of family offices out there who will say, look, preferred shares should have on the order in their mind of a 20 to 30% premium over common shares. That's what they are typically willing to pay. And you can break down the value of that common share into the different terms of it. And look, if you know that it's supposed to have a 20 or 30% difference between preferred and common shares, you can reverse engineer your math and your probabilities to say, well, the industry tends to feel it should be 20 to 30%. Let's do the math of the different potential outcomes and see what you can do to make it look like it should be 20%. And that comes out fair. So we will do those probabilities to say, hey, preferred shares, common shares should come out around 20%. If there is, I mean, another thing I didn't talk about is safe notes. People don't often think about it. Safe notes, if you do a safe note, always take a cap. It doesn't make any sense to do a safe note without a cap. If anyone cares, I can explain. But if you've invested in a safe note and your cap is 10 million, the company's just done another safe note round, and the safe note at that round is a 40 million cap. The safe note, which is a 40 million cap, has built-in option value that you do not have. So if there's a 40 million cap on a safe, this will mean that if the company raises at the cap, means if the next round of financing is above, they get 40 million. If it's below, they get the new financing round. So if the company funds at 30 million, well, the people who were funding 40 million get added option value because they'll actually fund at 30 million. Your cap, you're a 10 million cap. You're getting 10 million no matter what. So you can look at those option values of the cap, for instance, is that these are some of the other things you can do. And you can just say, what's the probability distribution of raise financing at further follow-on at different various follow-on prices. And it's probably going to distribute about the midpoint. The midpoint is probably around the cap. So you can make some reasonable assumptions to come up with things. Look, by the way, you can tell I'm an engineer the way I'm talking, and engineers, if you had to do the math on a bridge, when you're building a bridge across a river, I mean, we've been building bridges across rivers for thousands of years. And guess what? Nobody was ever able to analyze the math in detail of what would happen if so many ox carts went rumbling across the bridge at the same time. Where and how would the forces be distributed? you don't know that exactly. You can never know that exactly. And a mathematician will say, well, that's an unsolvable problem. And yet an engineer will say, I don't care if it's an unsolvable problem. We have to build a bridge. We're building a bridge here. And that's sort of what we were faced with is, I don't care if it's an unsolvable problem. What are the deal terms worth? Well, look, it's not going to be exact, but we can approximate it because we got to get across this bridge. So that's what we've been doing.
Amazing. We have one more really interesting question from Vicky. On average, how much equity do startups usually give up to get financing?
So it depends a little bit on the round you're in, but there's this really, really funny rule of thumb, which is, so in the early stages, if you're doing a sort of pre-seed round, friends and family, et cetera, you typically will give up on the order of 10% of your company, because that's what everyone expects you give up in a seed round. So you will go out and you will raise $200,000 from friends and family at a 2 million valuation because you're giving up 10%, and you can raise 200,000. That's what your friends and family have. So that's what you're valued at. And that's really driven as much by trying to keep dilution down so that the founder is incented to sort of keep running the business as you go through further rounds of financing. If you then move on and talk about sort of an institutional round, a late seed round, an A round, et cetera, the rule of thumb there, and this comes back to control provisions, is you're probably giving up about 25, 30% of your company in an A round, because in some countries, there are different protections for minority investors who hold more than 20% of the shares. And this has sort of become a, hey, I want control. To get control, I must hold 25, 30% of the, you don't want someone who's only 10% of the shares having a lot of control provisions over the company. It doesn't make sense. So, you can reverse engineer your valuation by how much you're raising. What you will hear is if you're trying to raise too money, people won't tell you, oh, your valuation should be lower. They'll just simply say, oh, you don't have enough traction. And you don't have enough traction is code for your valuation is too high. You need to prove more, do more to grow into that valuation that you want. And a VC will say you don't have enough traction, will also be implying, look, I only invest $5 million rounds. Don't come to a VC who does $5 million checks for $1 million because I only do $5 million checks. That's the size of thing I invest. And I need to take a minimum of 25 to 30%, but you do not yet meet those criteria. You're not far enough along yet.
Thank you so much for that, Kamal. So we had a couple of people sending in questions before the talk, and if it's all right, I'd love to ask them so that everyone can benefit. So how do you incorporate ESG and social impact in the valuation? That was the first question.
Yeah, it's interesting. And this is the same actually across the industry, is when you're doing valuations, valuations are based on what people will pay for it. And certainly companies which are ESG and social impact have access to a different group of investors. And some of those investors may feel differently, be willing to pay more because of the ESG and the social impact, because that's one of the things which motivates them. In our case, we're not going to value that explicitly. We are going to value, number one, what people have paid for it. I mean, ESG and social impact can be a performance thing. So you can come back and say, hey, here in the performance, we're running our business and we've discovered this new way to create a lot more social impact in how we run your business. Well, great, that's a performance thing. Your business will probably do better because you are doing better in this area of your business. What you do see in many firms in this space, though, is that ESG and social impact are a filter, which is just, you have it, you have enough, we can invest in you. You don't have it, you don't have enough of however we measure it, we can't invest in you. And it is still at a very rudimentary stage that people are using. And these screens are often applied very haphazardly. And you might have a very good social impact business, but someone else looks at it and says, I don't believe in your impact. So for instance, we have a company in the Netherlands, which is a peer-to-peer marketplace for people to rent household items from neighbors. So you can rent a party tent, you can rent a trailer, you can rent a ladder, whatever it is you want, electric drill, you can rent these things from your neighbors. And to many people, that just sounds like, well, it's just a peer-to-peer marketplace. It's a marketplace business. The reason he started this business off is he said, look at all this massive consumption we have. Why is it that everybody has a trailer in their garage when you don't need a trailer, you only need it a couple of times a year? And imagine how good it would be for the environment if we weren't buying all these trailers and drills and everything. Instead, we were just sharing them between people. So we look at that and say, yeah, that's a really great impact business. And yeah, we can quantify how much impact you're saving by fewer people in the neighborhood buying drills or trailers. But many people look at that and go, well, that's not an impact business. I mean, it's got amazing impact on the environment, but it doesn't have impact the way you think it has impact. It's not as clean or as simple as, oh, here's a solar energy business that has impact. Oh, you're just helping people buy less drills, buy less trailers. Oh, that's not really an impact business, even though you could measure the impact and say actually it has more impact. So that's the way you really see the sort of ESG and social impact being taken in. It's a screen. It will sometimes result in a higher valuation, and it does give you more people who you can access money from.
All right, thank you for answering that. We have a question that was sent to us via email right now, and it's coming from Annie. So Annie's asked, in how many rounds does Loyal typically invest in its portfolio companies?
So we've got a staged funding process, and so far we've invested in so we've taken companies through 3 stages of investing. We start with a $10,000, then a $200,000, then $1 million stage. We intend in the next year or so to start doing $3 million investments. Now, that sometimes translates into more rounds because we have sometimes, initially when we haven't had the capital available, and we're an open-ended fund, we depend on money coming in, new money. When we haven't had the money coming in, sometimes we've split the 200,000 into 100, or we split the million into a 500, and then we've taken part, for instance, in 4 rounds. Or so I'm trying to think. I mean, we might have taken part in as many as 5 rounds. I think, yeah, I can think of companies where we've taken part in 5 rounds. In theory, it's only 3 rounds, but I can think of a company in Nigeria where we've actually taken part in 5 rounds, and I think led a couple of those rounds.
Awesome. So I think we have time for 2 more questions, if it's okay, Kamal.
Sure.
The first question is from Sakun, and he's asked, in terms of valuation, where and how do we get the distribution of probabilities for different companies in different industries?
You know, that one's above my pay grade. I would definitely say, look, talk to people who are investment bankers, etc. Look, when we're doing, so my job is not to be the experts in industries. And I look very much, I mean, this Netherlands peer-to-peer marketplace company I mentioned, who is their comparable? Where do you sit down and say, okay, there's other peer-to-peer businesses, who are it's very hard. In fact, they have a competitor in Canada who just went bankrupt. There's other people who are in this industry who are really struggling because there's a lot of small details to make this business model work. I mean, it's not a very high value thing, allowing people to rent small household items from neighbors and taking a small percent of that transaction. There's not a lot of money in it. So it's actually our job when we do the valuations is to be experts in our companies, to know the probabilities for our companies of what their likely outcomes are. But honestly, we don't have the industry comparables. And your biggest challenge is almost nobody has those industry comparables, because those industry comparables should be for other startups. I mean, if you're comparing your startup against Google or Amazon and saying Google has this price to sort of these ratios, we have the same. I mean, your startup is not Amazon, it is not Google. Those ratios don't make sense. So you should really be looking at the probabilities of a whole bunch of other private companies, which nobody has. I mean, we've got our 225, but nobody really has all these things. So a lot of these probabilities, you've got industry level, sort of the whole venture industry, but it's really hard to get them. But having said that, maybe investment bankers have something you can use. I would start talking to people who are experts there, but it's not an easy thing to find.
All right, so last question for the night is from Luis, and he has asked, do you prefer investing through equity or safe?
Yeah. So Loyal prefers investing in whatever the entrepreneur wants. So we really don't care. It's the advantage. If you're doing equity and if you intend to do common shares in the future, then we would probably recommend doing common shares, among other things, because if you do a good common share round to start, you draw up a really good shareholder agreement. These are all the things we'll say. Is like, we'll tell you what goes into a good shareholder agreement so you can use it round after round. So you do your paperwork once, you do a shareholder agreement, you do a subscription agreement, and then you can raise round after round after round with exactly the same paperwork, with no special terms added, with, if it's well thought through, and you can put provisions in, minimum percent shareholding, give you an automatic seat on the board of directors. The board of directors must approve all these things. This is actually, I had a company which I ran for 6 years, which went through probably, I think it was like at least 8 rounds of financing, all off the same terms, all common shares, done completely simply. So if you are interested in doing that approach, then we would recommend shares. If you're not sure that you want to do common shares, if you think, look, everyone does preferred shares, I'll just do preferred shares. That's what people want. Then we would recommend a safe note. The advantage of a safe note, again, is that the legal is fast and easy. It's an off-the-shelf document, which is balanced for both parties, which you can just use to do a financing cheaply and quickly. So in that case, yeah, do a safe note. As mentioned, the one thing we always recommend is that make sure there's a cap on the safe note, because otherwise you're taking advantage of your early stage investors. By the way, look, your friends and family will accept an uncapped note. And many people say, oh, I'll just do an uncapped safe note. I'll take money from friends and family. But you're taking advantage of them. Put a cap. If the company does well, reward them. Don't have them sort of take all the risk and get a bad deal compared to later investors who come in.
Gotcha. Any other last questions? We have time for one last question. Feel free to write them in the chat box, everyone. All right. I think that's all the questions that we have for you today, Kamal.
I will say, by the way, if people do have follow-up questions, that they are more than welcome to contact me directly. It's kamal@loyal.vc. Happy to sort of do the best I can to answer them quickly or send you to someone who can.
Awesome. Thank you so much for taking out time from your busy schedule today, Kamal. It was a really enjoyable webinar, and I hope we all learned a lot from this session. Thank you so much once again. And good night. Have a lovely night, everyone.
Thanks.
Thank you.
Bye-bye.